Today's topic is one I wish every real estate investor could hear before they buy their first property. Because today we are talking about the biggest tax mistakes real estate investors make in their first year. And here is the thing, none of these mistakes happen because people are careless. They happen because no one explains the rules in a simple and practical way. So people do what feels right. And then when tax season comes by and suddenly things don't work the way they expected. So if you are in your first year or even in your second or third year, this is going to save you money, stress, and probably a lot of frustration. And by the way, I put together a really simple checklist that you can use to make sure you are not making any of those mistakes. So even if you are watching this on replay, mistake, and I will send you the spreadsheet your way where you can walk through everything step by step. All right, let's jump in. The first mistake that I see all the time is poor documentation. But here is the problem. The IRS doesn't care how good your memory is, obviously. If you cannot support an expense, it doesn't exist. So what ends up happening is people spend the money, but they cannot prove it. And now they're overpaying taxes on money they have already spent. And this one hurts because this is completely avoidable. Now, the next big one, and this is a huge one in year one, is mixing personal money with rental money. This happens all the time, especially when the property is still getting set up and it's not really generating income yet. So what do people do? They just pay for things from their personal account because it feels easier in the moment. And it's totally understandable, but it creates a big mess. A much cleaner way to handle this is if your real estate account, even if your real estate account doesn't have enough money yet, don't just pay from your personal account directly. Instead, transfer the money from your personal account to your real estate account and record this as a loan or owner contribution, depending on your entity setup, and then pay the expense from the real estate account. That way, everything stays clean, your books actually make sense, and when it's time to file taxes, you are not digging through a mix of personal and rental transactions trying to figure out what is what. It sounds small, but this habit alone can save you a lot of stress and money later. Now, let's talk about something that confuses almost everyone in their first year, and that is tax losses. A lot of investors go into this thinking, okay, my property shows a loss, so that's going to reduce my taxes across the board. And sometimes that is true, but a lot of times it's not that simple because rental losses are often considered passive, and passive losses can be limited depending on your income and on your situation. So what can you actually do about it? Well, for some people, if your income is within a certain range and you are actively involved in managing the property, you may be able to use a portion of those losses right now. When I say income has to be within a certain range, I'm talking generally about modified adjusted gross income being under $100,000 for the full benefit with a phase out between $100,000 and $150,000. For others, especially married couples, it may be worth looking at whether one spouse can qualify as a real estate professional if the facts truly support. That can completely change how those lots are treated. And in some cases, short-term rental can be the answer and can create more flexibility as well if they are set up and you materially participate the right way. And even if none of those apply right now, those losses don't just disappear. They can carry forward into future years and still be valued, but only if they are tracked properly. So the real takeaway here is this: just because you have a tax loss on paper doesn't automatically mean you are getting a tax benefit today, this year. A tax loss is not automatically a tax savings. And that's where planning make all the difference. And then the last big mistakes I will mention today is simply missing deductions. Things like mileage to your property, trips to Home Depot, small supplies, maybe even home office, depending on your situation. Individually, they don't seem like a big deal, but together they add up fast. And when they are not tracked or understood properly, they just disappear. And that means you're paying more in taxes than you do. So if you're listening to this and thinking, okay, I might be doing one or two of these, that's normal. Isn't about getting everything perfect. It's about catching these early so they don't turn into bigger, more expensive problems later. That's exactly, as I mentioned, I created this checklist that walks you through everything in a really simple way so you can clean things up now instead of trying to fix it under pressure during the tax season. Because the truth is, the difference between a stressful tax season and a smooth one usually comes down to what you did throughout the year, not just what happened after December 31st. And if you get this part right early on, everything gets easier. You feel more in control, you keep more of your money, and you are building your real estate portfolio the smart way. All right, that's it for today. If it helped you, share it with someone who just bought their first property, because chances are they're making at least one of these mistakes without even realizing it. And I will see you in the next live next week. Bye for now.